In a significant development that underscores the ongoing risks in the cryptocurrency sector, the FBI has accused North Korean-backed hackers of executing one of the largest known thefts of digital assets, amounting to approximately $1.5 billion in Ethereum from Bybit, a prominent Dubai-based cryptocurrency exchange. This incident, which unfolded earlier this month, highlights the vulnerabilities inherent in the crypto ecosystem as well as the growing sophistication of cybercriminals. The hackers, identified by the U.S. government as members of the notorious Lazarus Group, reportedly employed modified cryptocurrency trading applications embedded with malware to facilitate the theft. Trader actors are proceeding rapidly and have converted some of the stolen assets to Bitcoin and other virtual assets dispersed across thousands of addresses on multiple blockchains, the FBI noted in an online public service announcement. This tactic suggests a calculated effort to launder the stolen funds and convert them into fiat currency, complicating recovery efforts. The implications of this theft are profound. North Korea, which has been linked to an estimated $1.2 billion in cryptocurrency thefts over the past 5 years, leverages these cyber heists as critical sources of foreign currency to support its struggling economy and nuclear ambitions amid stringent UN sanctions and self-imposed isolation due to the pandemic. The UN has reported that North Korean cyber attacks between 2017 and 2023 resulted in the theft of nearly $3 billion, purportedly to fund the development of weapons of mass destruction. In the aftermath of the Bybit incident, crypto markets have experienced a notable decline. Bitcoin, which had briefly surged to over $100,000, has seen its value drop to around $82,000, reflecting investor unease stemming from the hack. The incident has been described by blockchain analytics firm Certic as the largest breach in blockchain history, and it has contributed to an overall market run of $800 billion since the beginning of the year. Bybit's co-founder and CEO Ben Zhou acknowledged the severity of the breach, linking to a website that offers a $140 million bounty for tracking and freezing the stolen crypto assets. Zhou explained that the attack was facilitated through a routine transfer from a cold wallet, indicating a sophisticated level of planning by the attackers. As the digital currency landscape continues to evolve, the regulatory environment is simultaneously undergoing significant changes. The SEC has recently adopted a softer stance toward cryptocurrency firms, as evidenced by the closure of an investigation into Robinhood Markets without any enforcement action. This shift could signal a new era of regulatory clarity that may encourage greater institutional investment and innovation within the sector. Despite ongoing challenges, there are signs of resilience within the crypto space. Companies like Resolve AI are actively pushing for mainstream adoption by launching platforms that allow consumers to make payments with digital assets, while PayPal is integrating cryptocurrency into its broader strategy. The evolving landscape is also seeing increased interest from institutions, which could provide the necessary momentum to elevate the industry. As the threat of cyber attacks looms large, the crypto community remains vigilant. The recent theft serves as a stark reminder of the importance of security measures and regulatory oversight in a sector that continues to capture the imagination of investors and innovators alike. Looking ahead, developments in both the regulatory framework and technological advancements will be crucial in shaping the future of cryptocurrency and its place in the global financial system. The challenge remains for the industry to balance growth with security, ensuring that it can thrive amid the complexities of an increasingly digital economy. As Bitcoin continues its tumultuous journey through early 2025, the cryptocurrency market finds itself in yet another downward spiral reminiscent of past market corrections. After peaking at an impressive $109,000 in January, Bitcoin has since dropped to approximately $86,300, reflecting a staggering decline of nearly 20% within just a month. This recent price fluctuation has reignited discussions among investors, analysts, and enthusiasts regarding the factors influencing the cryptocurrency's bearish trajectory and what the future may hold. The recent drop in Bitcoin's value can be traced to a combination of macroeconomic pressures and market sentiment. Notably, the cryptocurrency's all-time high in December 2024 led to heightened fears of overinflation reminiscent of the infamous crypto winter of 2022. Investors began cashing out to secure profits, thus exacerbating the downward trend. This price correction aligns with expectations following the Sell the News event on January 20, noted Paul Howard, director at Wincent. He indicated that significant ETF outflows and ongoing inflation concerns played pivotal roles in the current downturn. In addition to investor sentiment, external economic factors cannot be overlooked. The stock market has faced its own challenges, with major companies like Tesla and Walmart experiencing declines amid fears of geopolitical tensions and tariffs. These broader economic uncertainties have led many investors to retreat from riskier assets, including cryptocurrencies. Furthermore, a substantial security breach at the Bybit crypto exchange, which resulted in a $1.5 billion hack, has only deepened investor apprehensions about the safety of their digital assets. Despite these challenges, discussions around Bitcoin's future remain vibrant, particularly concerning potential investment from Texas. Recently, 2 bills were proposed in the Texas legislature to establish a strategic Bitcoin reserve for the state. These bills aim to facilitate the acceptance of Bitcoin for government philanthropic spending and emergency situations, with State Representative Giovanni Caprillion and Senator Charles Schwertner spearheading the initiative. The beauty of a Texas strategic Bitcoin reserve is it's primarily driven by donations and there's really no risk to the Texas taxpayer, remarked Lee Bratcher, president of the Texas Blockchain Council. Turning to technical analysis, Bitcoin's price behavior around critical support levels is crucial for predicting its next moves. As it currently hovers near the 200-day exponential moving average EMA around $85,650, analysts are divided on what lies ahead. While some, like former BitMEX CEO Arthur Hayes, warn of a potential drop to $70,000. Others argue that Bitcoin's recent dip represents a necessary liquidity hunt before a subsequent upward movement. Crypto strategist Michael Van de Poppy contends that the ultimate bottom might be between $83,000 and $87,000, setting the stage for a bullish reversal. Looking forward, the current market dynamics suggest that Bitcoin will continue to face volatility influenced by both internal factors such as investor sentiment and technical indicators, and external economic pressures. As the cryptocurrency strives to regain its footing, the ongoing discussions about regulatory frameworks and strategic reserves may play a significant role in shaping its future. With the potential for both bullish and bearish scenarios, investors and enthusiasts alike will need to navigate this complex landscape carefully, keeping a close watch on market signals and developments in the regulatory arena. The coming months will undoubtedly be pivotal in determining whether Bitcoin can reclaim its past highs or if it will settle into a prolonged period of uncertainty. In a striking turn of events, House Democrats are gearing up to challenge the legitimacy of meme-based cryptocurrencies linked to political figures, spotlighting the controversial $Trump coin launched by former President Donald Trump. Just weeks after its debut, the coin has plummeted in value, prompting concerns among lawmakers and investors alike. This initiative underscores a broader conversation about ethics in politics and the intersection of cryptocurrency and public service. California Representative Sam Liccardo, a freshman Democrat, has announced plans to introduce the Modern Emoluments and Malfeasance Enforcement Meme Act, aimed at preventing government officials from profiting off meme coins and similar digital assets. Speaking to ABC News, Liccardo expressed his surprise at being at the forefront of such legislation, noting, "That wasn't my plan when I ran for office, I can assure you." However, he quickly recognized the need to address what he termed self-evidently unethical behavior that raises serious questions about transparency and potential insider trading. The Meme Act seeks to impose strict regulations on federal officials, including the president, members of Congress, and their immediate families, prohibiting them from endorsing or participating in the issuance of securities or cryptocurrencies. Liccardo asserts that the Trumps profited significantly from their respective meme coins, particularly as early investors have faced steep losses since the Trump coin's value surged to nearly $70 shortly after launch, only to dive to around $12. He emphasized our public offices belong to the public, not the officeholders. Nor should they leverage their political authority for financial gain. While the legislation is unlikely to pass in the current Republican-controlled Congress, Liccardo views it as a crucial symbolic gesture against corruption and a potential rallying point for future Democratic initiatives. The bill also includes provisions for private investors to sue if they incur losses from meme coins tied to public officials, providing a layer of accountability in a largely unregulated market. The emergence of meme coins, often seen as speculative investments, has stirred a mix of enthusiasm and skepticism within the cryptocurrency community. Critics argue that such coins resemble Ponzi schemes, enriching insiders at the expense of naive investors. Proponents, however, see meme coins as a novel way for the internet to revolutionize financial transactions. As Liccardo's bill gains traction, it highlights the ethical dilemmas posed by the crypto market, particularly when intertwined with political interests. The recent downturn in the cryptocurrency market, which has seen a staggering $800 billion in losses, has further fueled scrutiny of Trump's crypto ventures. Analysts attribute this decline not only to the volatility of meme coins but also to a broader disillusionment with the former president's promises regarding the crypto sector. Gotti Chait, an investment manager at Xapo Bank, remarked on the slower-than-anticipated rollout of any major pro-crypto policies, which has left many investors feeling frustrated and seeking safer assets amidst rising inflation and economic uncertainty. As the political and financial landscapes evolve, the implications of Liccardo's proposed legislation extend beyond mere regulation. They invite a necessary dialogue about the ethical boundaries of political influence in emerging markets and the responsibility of public officials to act in the best interests of their constituents. Moving forward, as the cryptocurrency market continues to adapt and respond to regulatory pressures, the focus will likely remain on the accountability of those who wield political power in conjunction with financial ambitions. The coming months will reveal whether such measures can effectively safeguard the integrity of both democracy and the burgeoning world of digital assets. And the ever-evolving landscape of cryptocurrency rumors and market dynamics can shift rapidly, often leaving investors in a state of uncertainty. Recently, speculation swirled around Binance, one of the largest cryptocurrency exchanges, leading many to believe that the platform had offloaded significant amounts of Bitcoin, BTC, Ethereum, ETH, and Solana SOL. However, these rumors were swiftly dispelled, with Binance clarifying that it had not sold any of these major cryptocurrencies. This clarification comes at a time when the crypto market is facing considerable volatility. With the total market capitalization plummeting from $3.57 trillion to below $2.85 trillion in just a few weeks. Amid this backdrop, the price fluctuations of major cryptocurrencies have drawn the attention of analysts and investors alike. Ethereum, for instance, has recently found itself in a potential accumulation zone after experiencing sharp declines. Historical data reveals that significant purchases by large holders, commonly referred to as whales, often precede upward price movements. A notable transaction involved the Seven Siblings wallet, which acquired over 12,000 ETH for approximately $28.75 million. Such strategic purchases signal strong bullish sentiment despite the broader market distress. Market analysts are divided on the future trajectory of cryptocurrencies like Ethereum, Solana, and Ripple XRP. Technical indicators suggest that Ethereum is approaching critical support levels, making it a possible buy opportunity for investors looking to capitalize on potential rebounds. If it can hold around the $2,480 mark, there is speculation that ETH could rebound to $3,500 or even higher in the coming months. The sentiment is echoed by influencers in the crypto space, including prominent YouTubers and market analysts who advocate for accumulating positions in top cryptocurrencies during dips. Solana, on the other hand, has demonstrated remarkable resilience throughout its price correction. Following a meteoric rise that saw SOL surpass $250, the asset has since retraced to the $140 to $150 range. This level is viewed as a prime accumulation zone, particularly as institutional interest in Solana remains strong. Analysts predict that if market sentiment shifts positively, Solana could reclaim $200 and potentially retest its previous highs. XRP, despite its ongoing legal battles with the SEC, has also captured attention as it retraces toward historically significant support zones. The asset's recent price trajectory suggests that it may be on the verge of re-entering price discovery mode. Analysts point to diminishing selling pressure and an increasing number of active addresses as indicators of growing interest that could propel XRP's price higher if institutional demand continues to rise. Adding to the complexity of the market are significant movements by institutions. BlackRock, a major player in the financial sector, transferred over 5,100 BTC and 30280 ETH to Coinbase, leading to immediate reactions in the market, including price drops for both Bitcoin and Ethereum. This activity underscores the importance of monitoring institutional trading patterns, as large transfers to exchanges often signal potential selling pressure that can influence market liquidity and prices. The convergence of institutional momentum and retail sentiment presents both risks and opportunities for investors. While the actions of large holders indicate confidence in the long-term value of cryptocurrencies, the current market volatility suggests that caution is warranted. As traders navigate these turbulent waters, the potential for significant price rebounds remains, particularly for large-cap tokens like ETHSOL and XRP. As the crypto market grapples with uncertainty, analysts and investors will be closely watching key support levels and institutional activity to gauge potential recovery patterns. The coming weeks will be critical in determining whether this market correction is merely a temporary setback or the beginning of a more prolonged downturn. With the landscape continually shifting, it is essential for participants in the space to remain informed and agile to adapt to new developments in the ever-fluctuating world of cryptocurrency. As the cryptocurrency market continues to evolve, the spotlight is increasingly on Solana, a blockchain platform that has captured significant attention for its speed and scalability. Recent developments, including the introduction of Solana futures ETFs and an ongoing bullish sentiment toward the cryptocurrency, suggest that Solana is poised for a pivotal moment in its trajectory. On February 27, 2025, the Depository Trust and Clearing Corporation (DTCC) announced the listing of two Solana futures ETFs from Volatility Shares: the Volatility Shares 2x Solana ETF SOLT and the Volatility Shares Solana ETF SOLZ. This listing is a crucial step toward mainstream acceptance, as it allows these ETFs to be eligible for clearing and settlement through established financial infrastructure. However, it is essential to note that this listing does not equate to the approval of these investment products by the U.S. Securities and Exchange Commission (SEC). Volatility Shares has been actively working to expand its offerings, having filed with the SEC for 3 new ETFs tied to Solana futures contracts last December. The introduction of these futures products is particularly noteworthy given that until recently no Solana futures contracts were available on any Commodity Futures Trading Commission (CFTC) regulated exchanges. The launch of these futures contracts by Coinbase Derivatives LLC earlier this month marks an essential stride toward enabling institutional investors to engage with Solana in a more structured and secure manner. Eric Balchunas, an ETF analyst at Bloomberg, emphasized that the launch of Solana futures represents a promising indication of the cryptocurrency's growing institutional acceptance. The availability of these futures contracts is paving the way for potential ETF approvals, which would further enhance Solana's credibility in the financial markets, Balchunas noted. As the market gears up for possible ETF approvals, Solana's price behavior remains a point of interest. Recent analyses suggest that Solana is experiencing a bearish trend despite the ETF speculation. A report from FX Empire highlights that while excitement around potential ETFs is high, the price movement has not yet reflected this optimism. This sentiment underscores the cautious optimism that characterizes the cryptocurrency market, particularly as participants await regulatory clarity and broader market stability. In addition to these developments, Solana has become a focal point in discussions regarding the next bull run in cryptocurrency, with analysts identifying it as one of the top contenders alongside established players like Cardano. The ongoing interest in Solana can be attributed in part to its reputation for facilitating rapid and cost-effective transactions, which is particularly attractive for retail developers. At the same time, new entrants such as Roblox, a play-to-earn crypto casino, are gaining attention for their potential to reshape the landscape. With over $10.7 million in liquidity raised and a robust game offering, Roblox represents the kind of innovation that has historically propelled cryptocurrencies into the limelight. As we look ahead, the interplay between regulatory developments, market sentiment, and technological advancements will likely shape the future of Solana and its standing in the cryptocurrency ecosystem. The potential approval of Solana ETFs could catalyze a new wave of investment, while innovations like Roblox may redefine user engagement within the crypto space. In conclusion, Solana's journey is emblematic of the broader trends in the cryptocurrency market, where institutional acceptance, regulatory clarity, and innovative applications converge. As the year progresses, stakeholders will be keenly observing how these dynamics unfold, potentially heralding a new chapter for Solana and its community.